What's going on, guys? Today I'm going to be talking about poor man's covered call, how to make consistent monthly income on a lot less money. I'm going to show you an example of a leap option, selling the call options, and creating this passive income strategy with PLTR stock, but I'm also going to show you using Tesla stock. See, the problem with covered calls, and this was brought up to me by my Discord community, and they've asked me this question: Henry, I don't have a six-figure account yet. My portfolio doesn't really have the capital to be selling covered calls on a large scale. I can only sell one or two covered calls here or there. It'd be awesome if there was a strategy that can allow me to make profits without needing to buy 100 shares of stock, because that's too expensive for me. So I listened to my community and I'm going to show you how to make the same money potentially as if you had 100 shares. However, you're not going to need that. You're going to need a lot less capital, but still be able to have the upside and the income in a very similar way as if you were to have a covered call position. Now, all I ask is that you give this video a like. It'll help you get stupid rich, and it's free and super appreciated by Uncle Henry. All right, so for those not familiar, a covered call is just buying 100 shares of stock and selling a call option. Now, a poor man's covered call is going to be pretty similar in terms of how it behaves. However, it's going to involve buying a leap option and then selling call options against that leap. A typical poor man's covered call consists of two call options: a long, deep in the money call option with about an 80 delta. Now, this call option acts like a stock for a fraction of the price. This call option is treated by your broker similar to stock because it has such a high chance of expiring in the money. It gives you the coverage of selling a call option, being that it's a deep in the money call option. The 0.8 delta will ensure that the option moves as close as possible to a covered call position. Now, because you have a deep in the money call option, this call option gives you the ability to sell call options against it as if it was 100 shares of stock. Now, you basically have a similar position, except there's a few things that you need to keep in mind that I'm going to introduce to you. First, there's some flexibility here. Some people like going for a 0.7 delta, while some other people like to play it very safe and go for a 0.9 delta. I'll have an example for you guys in just a few short moments. I'm going to go down here to trade PLTR options, and I'm going to show you guys an example in just a second. What you need to know is the delta is really flexible, and this is where the poor man's covered call can differ from other YouTubers or option trading professionals. Step number one, you need to go for a leap option that is out of the money. You really want to go for something that is not that close in terms of its expiration date, because that option is going to be a leap. A leap, by definition, is an option that is about 1 year away. Now, the other benefit of buying a leap option is that the time decay will be very little, since its expiration is so far out in terms of its date. So for this example, I'm going to click January 20, 2023. Leaps are used because they're the least affected by time decay compared to near-term options. In fact, take a look at this. I'm going to expand the 25 strike for PLTR right now. And as you guys can see right here, the theta is 0.0061. If you multiply this by 100, you just move 2 decimal points over, this is still not even $6 per day. In fact, it's going to be 60 cents per day. So your opportunity cost of holding a leap option starts out at 60 cents per day, which is pretty rock bottom, considering I'm about to show you how you can make 10, 20% a month on this option. All right, so what we need to do is we actually have to execute the trade. Now, the market's not open, but I'm going to show you the full example and just walk through the numbers. All right, so we see that this delta right here is 0.51. It is not going to be a good poor man's covered call because it's not near that 0.7 delta. So in fact, I'm going to have to close this option out, and I'm going to go for an option that is in the money. And in the money option would technically be around $20 because the current stock price is $20.46. So the $20 strike is already in the money. However, I'm going to bet if I were to click this, it's going to be about a 62 to 67 delta. All right, so it's 65. So that's not quite there yet. So I'm going to go down a leg lower to the 17.5. All right, cool. We see a 0.73. So that's fantastic. Let's actually take a look at the 15. This is an 80 delta. So that's really good. That's the midpoint between a riskier poor man's covered call and a super safe poor man's covered call. Now, notice the theta, guys. The theta has actually gone down. So before I was looking at an out of the money option at 25. Now, that's the reason why out of the money options are sometimes much worse than in the money options, because they may expire out of the money and that's not going to be a profitable trade. However, going for an in the money option is oftentimes better because the delta is higher, meaning that you have a higher chance of the option expiring in the money, but also theta oftentimes is lower lower. So buying this leap option, you're only going to be losing about 43 cents per day. Now, obviously, I'm going to show you how to make a lot more money than that, but there's still a cost to running a poor man's covered call. It's just a very tiny fraction of owning a real covered call. And I do want to say the assumption here is that a poor man's covered call is going to mimic what a covered call is supposed to do. The main goal of a covered call is that you collect income on a stock that you are bullish on. So you really need to find a bullish stock. Now again, Henry, why can't I just sell call options without owning any shares or without even owning a leap option? All right, so we're gonna go ahead and buy this 15 strike call option for Palantir expiring on January 20th, 2023. So it's gonna cost a total of $805. Now what I'm going to do is I'm not just gonna open up this long call option, I'm gonna get started with the poor man's covered call. Now the poor man's covered call involves selling closer expiry date call options. We can pick a week out, we can go a month out, we can even go 3 months out. I typically like to go between 30 to 60 days. So being that today is basically Thanksgiving, it's 11/26, I'm going to go for an option that is expiring in late December, which is December 23rd. Awesome, now that we have picked December 23rd as our expiration date, now what we're going to do is we're going to look at the strike prices and pick a strike that we want to sell a call option on. So treat this as if it was a covered call position, okay? So if you had 100 shares of Palantir and you just bought the stock at $20.50, you determine the price that you think Palantir will go up to, or whatever stock you're using. Obviously, you don't need to use Palantir. I'm just using this as an example. So let's say you purchase a stock for 20 and you're willing to sell it at $23. That's the strike that you're going to pick. So looking at the Palantir 23 strike price, you're going to expand the option. You're going to take a look at the delta. It's 0.3. That checks out because the chances are lower than 50%, which is fairly safe. However, if you want to be even safer, you can go further out of the money. You can go for an option that, might be at the 24 strike, because the 24 strike is not going to be a 30 delta. It's going to be a 21 delta. You can go as high or low as you wish. I prefer to go for deltas that are between 20 to 25. So the 24 strike checks out perfectly for me. Now the theta right here, guys, this is where it gets really interesting, okay? So the theta on our leap option was 43 cents, okay? This call option right here is 43 cents. For this call option that we're going to be selling, which is expiring December 23rd, the theta is 0.017. Now, because each option is 100 shares, if you move the decimal point 2 times, this is actually $1.70. So technically speaking, you're making $1.70 per day and you're losing about 40 cents, or in other words, you're making $1.30 every single day that you hold this option. What that translates into per month is about $40 per month. Now, $40 per month might not seem like a lot. However, consider this. You're making $40 per month on your total cost of about $800. $40 divided by $800 is going to be a 5% return in a little bit less than a month. So basically, you can make over 5% return in a single month. Now, because our leap option here expires January 20th, 2023, which is about 13 months away, 13 times $40 per month is going to be $520. So you can make $500 in basically 1 year on $800, which is going to be a 65% return. Now, a question that you might be thinking is, what happens to this leap option right here? Won't it decay? Well, the answer is technically yes. This call option will decay. However, if the underlying stock just stays the same or slightly rises, right? This is a 15 call option. So let's say by 2023, the stock goes up to $23, which is not out of the question, right? A stock going from 20 to 23 can happen in a single week, yet alone in a single year. So if the stock actually goes up just a little bit, this option will not decay. This option will stay at the current value of $800 as long as the underlying stock just rises a little bit. Now, this option can decay if the stock goes down. Obviously, you would lose some money, just like you would lose some money on a covered call anyways, right? If you're owning 100 shares of stock and the stock ends up pulling back, you're going to be losing on the stock anyways. A poor man's covered call works in a very similar way. If it goes down, you will lose some money, but if it goes up, you will make money. But even if it goes sideways, more likely than not, you're going to be collecting more money from the call options that you're selling on a monthly or weekly basis than the 15 call option or the deep in the money leap option that you bought. So this is going to be, in most cases, a win-win. Now, I do want to pull up Tesla stock because this is something that I've been really thinking about with Tesla stock. I do have a lot of shares. I'm up about $258,000 on Tesla stock. I've been an early believer in Tesla. I've been talking about it for a number of years now. And the poor man's covered call strategy is something that I really want to use on Tesla, specifically because I still am bullish. So I'm going to show you what that would look like. Now, again, for a leap option, this is where I want to do a modification for you guys, because for Palantir, I went out until January 2023, but I want to show you guys that you can still run a poor man's covered call without having to go out so long in terms of date, because I know some people want to have some quicker results. They don't necessarily want to wait a whole year to see a position play out. So I'm going to go for March 18th, 2022 for Tesla. I'm going to be buying a call option. I'm going to show you what this looks like. It's not technically going to be a leap option. However, you can still buy a deep in the money option and have it mimic and look very similar to a covered call, because doing a covered call on Tesla is going to cost $110,000. That's expensive even for a 7-figure portfolio. So I want to show you guys what a poor man's covered call would look like on a more expensive stock. It doesn't have to be Tesla. It can be Google. It can be Amazon. It can be Chipotle. It can be a number of more expensive stocks. And you might want to do this instead of just doing a covered call, or instead of just buying call options. This is a fantastic strategy to have in your toolkit. So taking a look, I'm going to do a modification here. I'm going to open up the 1000 call option. The delta is 0.68. So this would be a more risky option, because again, 0.8 delta is, right in the middle point. 0.9 delta is very safe, and a 0.7 delta would count as a more risky poor man's covered call, because if the stock does pull back, then you are at a risk to lose some money. However, if you're bullish on a stock, you have a lot of belief and conviction in it, then going a little bit more risky is actually going to have a bigger payoff. I'm going to show you how much more money you can make on a riskier play than the safe play that I showed you with Palantir. So looking at the 1000 strike, I'm going to go ahead and buy this call option right here, $222. This is actually going to be $22,000. So of course, this is a little bit more expensive. However, again, you can just use this on a middle of the ground stock. You can find a stock that's, $50. You can find a stock that's $100, or you can find a stock that's $1,000. And I think this strategy is really good on any stock that honestly has some volatility. All right, so we're looking at the March 18th. Now what we're going to do is we're going to go back in terms of dates. We're going to go again and pick December 23rd. This is going to be about 1 month away. I'm going to click sell call option. Now this is where I'm going to pick a strike price that is just slightly out of the money. I'm going to pick about 1150. Take a look at it, 47 delta. That's quite too close for me. So I'm going to go up a little bit more, because again, you don't want to get executed on this position, because you will actually have to roll out of the call. If the call ever goes into the money, what you would want to do is buy back that call and sell a new call for a later date. This is called rolling, and I do have a video on it that you can check out in the description, or by watching my option playlist, which I will also link in the description. All right, opening up the 1200 strike, the delta is 0.38. That's a lot safer. That's what I like to see. So I'm going to go ahead and sell call option. And you guys can see right here that this is about $5,000. So although we're going to be spending about $20,000, you can collect $5,000, which as a percentage of $20,000 is a 25% return. So you can get 25% here, and the expiration is about 4 months out. So you will basically cover your exact cost. However, if the underlying stock ends up going a little bit higher, not only can you make 25%, but you can also make more money than you paid for this call option right here, which we will call it a leap. It's not actually a leap because it's shorter than 1 year. However, you can actually end up selling this for, maybe $30,000 and still collect all of the premium from selling calls. So if all goes well, you can make 25% per month, plus you can exit the position for, a slight gain, whether it's 25, 30, or 40%, something along those lines, as long as the stock is going up. Again, don't forget, this stock is in the money. In the worst case scenario, if Tesla just goes sideways, or if your stock just goes sideways in this example, then you're still going to be left with about $10,000. So if you collect $5,000 4 times, that's going to be $20,000. And then you're going to be left with about $10,000 if the stock stays flat. So even if the stock just goes sideways, it does absolutely nothing, you will end up making about $30,000 on your total cost of $22,000, or in other words, making a 36% return. That 36% return translates into about $7,200, and over 4 months, that's going to be $1,800 per month. So there you have it. You can make $2,000 per month on a small portfolio of about $22,000 running the poor man's covered call strategy. If you want to be part of a successful community, then go ahead and check out the private Discord in the description below, or feel free to check out more of my small account trading portfolio videos here on YouTube. Thank you so much for watching, and I'll see you guys in the next one.